Heavy is the head that has to manage all of this.
Hey everyone, welcome back to my channel.
We're now incentivized to buy what we already buy.
Fumbling through college had me building.
I also got some done on the other side.
And that was right around, I would say, May, maybe, right before renewing the lease for this property.
Welcome to the channel, Martha.
Thank you for having me here.
Oh, I was going to say, I am getting up in their names, I'll tell you what.
Bills paid by other people, life was never this good. I had to step back.
Hey everyone, welcome back to my channel. So like I always like to do, today we're actually going to go over one of my portfolios, one of my accounts that I actively use and manage in order to see what exactly I'm going to invest in moving forward. So right here, you get a sneak peek. You get a sneak peek of what I'm currently invested in. All right, so you just saw 55,000, a little over 55,000 there. Over the course of a year so far, I've made about 19,000 on this account. So the net cash flow I'm receiving right now, $36,699.55. On this one individual pie, I'm showing $44,832.05 currently. Dividends earned this year. This is why I love dividends so much. Dividends earned just this year is going to be $1,756.13. Somebody do the math. Let me know what percentage of my portfolio have I earned in dividends this year. Money weighted rate of return is 65.90%. Now, I don't know what that means exactly, which is shocking coming from me. A money weighted rated, that is a tongue twister in itself, especially with the new braces in. A money weighted rate of return, 65.90%. You guys let me know if that's good. Let's actually Google that too. And you guys let me know if that percentage rate of return is good. So the money weighted rate of return looks at a fund's starting and ending value and all cash flow in between in an investment portfolio. Cash inflows are a part of it. These inflows could be from deposits or investments made during a certain period. And so 65.90%, I would say, is absolutely phenomenal in that regard. And we all just learned something new together today, because if I ain't know it, a lot of other people didn't know it. And this is a guy who's been investing for several years. So a few updates on the portfolio that you may not have been aware of. And the reason why I'm doing this today is because so many people ask me, what am I invested in? What am I invested in? I show you my portfolio all the time, and yet you still have more questions. So it's not enough for me to just show you my portfolio, but is more, maybe you're scared. Maybe you're thinking about investing and you still are on the fence. The first thing I want to say before we even dive into my portfolio is that if you're scared, there's no way for you to make money. Like Meek Mill said, scared money don't make no money, and I won't say the rest of that song, okay? But another thing that I wanted to reiterate is that most people get rich through having a primary house and a 401k. The only way to get, well, I won't say the only way, but how most people get rich, again, is a primary residence, a house that you live in and own, and your 401k or Roth IRA. Without those things, it is very unlikely, unless you are getting passed on generational wealth or businesses, to be able to make it in America without those two things. The 401k and Roth IRA is typically not managed by the individual themselves. So you typically don't manage it because of your fears, because of your willingness to take out money before its maturity date, because of all these things. Honestly, the 401k is set in place to help you. They manage it. They already have your investments going towards certain stocks and ETFs. And then there's a penalty if you do an early withdrawal. So you're going to lose 10% of your money at the very minimum for withdrawing early. And if you take a loan against that money, you have to pay it back within a year as well. And so there are so many things that kind of prevent you from taking money out of that 401k and Roth IRA. And it's for your best interest, because you won't believe how many people have told me, hey, I got X, Y, and Z in my Roth IRA and 401k. I'm going to pull this money out. Or, hey, I just happened to stumble on the fact that my company had been investing some of my money without my knowledge, and I'm going to pull this money out and do blah, 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 blah with it. A lot of people would not invest, would not save if they had the choice. They would tell me that they're absolutely broke. But when your business literally takes your money and invests for you without your knowledge, all of a sudden you are still able to live, survive, and live your life without without that money. And as soon as you figure out that you had that money, all of a sudden you need it. You need it to buy a new car. You need it to do this and that. You need it to pay off debt that you weren't paying off before. It is just absolutely insane to me what people do once they realize they got a little bit of cash that they weren't expecting to have. All right. So now we're going to get into my portfolio. Right now, today was a really good day. I'm seeing a lot of profit across the board. We're going to start with one of my heaviest stocks. In fact, it is the heaviest stock in my portfolio. It's surpassed Tesla. I have two ETFs that have surpassed Tesla and one stock that has surpassed Tesla. So officially, the highest rated stock in this portfolio is going to be Meta. Meta has $2,964 in it. Has gone up all time since I've had it. I have made a cash flow of $1,030.71 on Meta, which is a 258.12% rate of return. Again, I really believe in Meta. I believe in their vision. But we're still going to read a few little articles about it. It says Meta's Instagram failed to curtail hate speech against women politicians, report says. Meta bullish outlook. Why now is the time to buy into AI and advertising gains? Meta's deep dive too cheap to pass on. Trades of 22 times forward earnings despite double-digit bottom line growth. And then 3 AI stocks poised for a comeback, and I'm sure Meta is probably on that list. All right. So with that being said, Meta is actually down on the day just $4.50 in my portfolio. That's 0.85%. The stock is currently worth $524.04. That is insane. I remember when it was worth $50. Okay? $524.08 right now. That is insane. I am so proud to say I own Meta. I'm so proud that I got in when I got in. I'm so proud to continue to invest in Meta and their innovation for years to come. I know that with their digital reality, for me personally in my life, is going to affect my future children and their future children with virtual reality and the things that they're putting into the world. I'm not going to spend too much time on Meta because obviously it's a stock that I love. There's a few ETFs that I'm also going to skip for the sake of time, because with 28 different pieces of stocks and ETFs in my portfolio, it could really take 2 to 3 hours for me to go over everything. And some of you might want that. Let me know in the comment section down below if you actually want me to do something like that in the future, because I don't normally sit down and go over my portfolio the way I'm doing today with all of you. And so if you absolutely love it, let me know so that we can talk about this more. I know I have a lot of people who are 18 to about 44-year-olds that watch my channel. And so I really want to get you moving in the same direction mind state wise to understand what it is that I'm invested in. So I'm going to give you a quick look, and then we're going to get into the next one. All right. So the next thing here is VOO. We're not going to talk about that too much. And SPY was the second one. We're not going to talk about that too much. Roughly, there's about $6,000 in between those two accounts, in between those two ETFs. They're basically the same thing. VOO and SPY are basically the same thing. I like VOO because it tends to outperform SPY by a little bit. So it's showing me that I have year to date. Is it year to date that we're looking at? Yeah. So we're looking at year to date. It's showing me 98%, 98.72% on VOO is the growth that I've had, and 93.8% is the growth that I've had in SPY. Not that great. Now, Tesla was down a ton for me earlier in the year, but Tesla is starting to bounce back. It's averaged out at 6% of my portfolio. Right now, I'm still at a loss all year round, 5% on Tesla. I'm okay with that. I'm going to keep my Tesla. We're going to keep on moving. Now, I'm also going to look at today. See, Tesla is down on the day about by 3%. So that contributed to that 5% loss there. In a year, Tesla has been down 8%. Not bad. That is insane. So now if I'm looking at my year, just to this year, every single company is positive for growth except Tesla and Johnson & Johnson in my portfolio. But we're not just going to talk about Tesla and Johnson & Johnson. Now that I know all year those two companies have been suffering, I'm obviously going to target those more than the other companies in my portfolio. But I also want to look at all time what companies have not been making me money. And so Johnson & Johnson all time, I'm still up 16% on Johnson & Johnson. But you know what company has failed to make me money all time? Sony, PlayStation. I bought them because they had the PS5. I bought them because they're going to be big players in the gaming space for years to come. But they're only 1% of my portfolio, and that's for a good reason. It's because they're still down 7%, and I need to see more from them. And we're going to look more into Sony to see if whether or not I should cut my ties with them. ADM, Archer & Daniels, is a great company that I believe provides food and resources to the communities. I am down 21% on Archer & Daniels, and I have 25 shares of Archer & Daniels. The cost of that is about $1,698 in my portfolio today. And we're actually about to deep dive into Archer & Daniels right now, this instant. This year, they are up 227% in my portfolio at the very least, with my dollar cost averaging and everything else. However, all time, they're still down 21%, and I don't like that whatsoever. Maybe I just bought at the wrong time, because I do see that they took a real big dip back in 2024, January, and they started to climb up since then. Back in July, they were pretty good. May have been very profitable for me back in July, but now they're not. They're not so profitable. So let's go ahead and research ADM and see if they're still worth keeping. When I type it in, I type in ADM stock. Archer & Daniels Midland Company comes out. Start looking at their 1 day. This is the stuff that I do in order to get an idea of whether it's a good buy or not. Their 52-week range is from $50.72 to $83.15. I'm not going to lie to you guys. Right now at $58.20, it's a buy compared to their 52-week high. You would buy now because it's at the low end of their last 52 weeks. Now, there are people bidding on this stock at 58.24, so not too bad. They're buying in about 3 cents short because it's now at 58.21. So it's climbing up just a little bit. Their ex-dividend date was August 21st, 2024. All right. Now I have to make sure that they're still paying a dividend. I believe that's for people who didn't get in by that date in August 21st. It's right now August 15th, 14th. So if you don't get in by August 21st, you won't be eligible for the dividend. Does ADM still pay a dividend? I believe they do. Yes, they do. So their next dividend payment is coming out September 11th, 2024. All right. And I'm going to make sure to put out this video before the 21st. So anyone who is interested may still be eligible to get a piece of that dividend payout. All right. Their quarterly dividend amount per capital is about 50 cents US quarterly, which is roughly about what, $2 a year per every $58.22 that you invest, which is a big boost because again, their high is about $80. So if you buy at 58, you get a $2 dividend a year, and then you have the potential of going up $22 in growth per share. If you buy 10 of these, you have the potential to go up $220 plus another $20 in dividend, making it $240, and you're all in with less than $600. That's pretty damn good. Imagine making what is that, like a 30% return on your money? And this is exactly what I do, guys, right? People are so interested in making 10%, 11% returns. I go out there and I do 69%. I go out there and I do 30%. It's because I can see the value in this company, although it's down right now. But before I invest in this company, which I'm already invested, as you all know, and it's one of the only 2 companies failing for me right now, I need to know, why aren't people buying this stock? Why is it going down? There must be some negative news about this company. So it says Archer & Daniels Company periodic dividend will be increasing on the 29th of February to 50 cents. This was back in January. With investors receiving 11% more than last year's 45 cents. Based on this payment, the dividend yield for the company will be 3.3%, which is fairly typical for the industry. Then it says Archer & Daniel is well covered by earnings. Unless the payments are sustainable, the dividend yield doesn't mean too much. Before making this announcement, Archer & Daniel was paying a whopping 197% as a dividend, but this only made up 24% of its overall earnings. A cash payout ratio this high could put the dividend under pressure and force the company to reduce it in the future if it were to run into tough times. Looking forward, earnings per share is forecasted to fall by 26.8% over the next year if the dividend continues along this path it has been on recently. We estimate the payout ratio could be 37%, which is comfortable for the company to continue in the future. All right. And to be honest, were they wrong? Were they wrong in their assessment? Because at the end of the day, the company did pay a bigger dividend, but what happened was they lost a lot of money by paying this dividend to us, and so it's not growing as it should. And everybody knows me. I like dividend growth stocks. Again, dividend growth stocks. However, I still do believe in this company. They paid more than what they could afford, but they're not going anywhere. And right now, I already believe it's at the bottom. So if negative 21% is the bottom, then I need something to replace it, or else I'll just stick with ADM. I'll just stick with Archer & Daniels. But you know what? Right now, it's only, I believe, 1% of my portfolio. Let's take a look again. Let's take a look. What percentage is Archer and Daniels in my portfolio? Have you all been paying attention? Let's see. They are 3% of my portfolio. And right now, they're overweight. They're 3.2%. So with that being said, it is a fair assessment that I might need to reduce my position in Archer and Daniels or eradicate it completely because I have so many winners. I don't need any losers. You know, I wanted to support agriculture and things like that, but let's see. And I'm not even sure what Archer and Daniel does anymore because it's been so long since I've had to evaluate them like I normally do. So let's take a real good deep dive into Archer and Daniel. So I just type in ADM stock and what the company does. Nature Power Unlocked. World's Nutrition Company. So yeah, it's exactly what I believed it did from my research probably like 2-3 years ago, guys. So it's been a while since I've actually had to look at Archer and Daniels like this. They're down in revenue by 11% year to year. Their net income fell 47%. They're diluted 42%. Their net profit margins are down 40%. They missed their revenue by 3.92% in June. That's tough. That is tough. So although they have the potential of getting to $80 a share, it is also unlikely based on what they're projecting to do with a higher dividend payout. And I would hate to get rid of a company right before I get paid that sweet dividend. But they're on the chopping block, and I'm going to put it in my notes right now that ADM is on the chopping block for me. So you see how quickly things can change from a company that I really, really like to a company that is not making me money, and business is business. Sometimes you got to cut them loose. All right, and with that being said, we're going to move on. We're going to move on to another company that I really like, but just off potential alone is not good enough. Just off potential alone is not good enough. So we got to move on to Sony Corporation, and see what they're all about. I want to see, are they profitable? Are they making money right now? What's going on? So year to date, they're down 6%. 1 year return is up 4%. 3-year return is down 12%. 5-year return is up 58%. All right. Let's look at their Q1 earnings report. Tokyo-based company had a net income of $1.22. The results beat Wall Street expectations and by about 11 cents. So that's good news that they did beat the earnings expectations in Q1. But guess what? We're about to finish Q3, so I need to see what their report is for Q2. So 7 days ago, it states that Sony outperforms with double-digit profits, reporting a 10% rise in operating profits from first quarter, beating analysts. Well, they're still talking first quarter, 7 days ago, which is insane. What happened in the second quarter now, right? What happened in the second quarter, Sony? I know those PlayStations aren't still selling in late 2024, so what's going on? Where's the money? All right. Ex-dividend date was March 27th. Forward dividend and yield is 0.57. So Sony is a real stickler about when they're going to pay someone a dividend. If you didn't sign up by March 27th, you missed their next dividend payout, which is May, June, July, which they should have already paid. And now we're already in August, so they should have a new ex-dividend date coming out soon. All right, Sony is at 89 cents a share. Not really a buy right now. Their 52-week range was $75.11 to $100.88. I don't really see Sony going to 100. There's no news that can come out right now that's really going to move the needle on Sony. There's really no innovation that they've been doing. And, you know, I really had high hopes for them with the PlayStation. I didn't see a lot of games come out this year. Sony is also on the chopping block for me. And unlike ADM, it's more likely that I get rid of Sony stock because I just don't really see a bright future for Sony. In fact, Sony might be one of those companies that die out in a couple of years. Remember I said that first. And that's very unfortunate because I've been a PlayStation guy my whole life. Never Team Xbox. But it is write down in the comment section below if you're Team PlayStation or Xbox. Only those who stuck around 25 minutes will know. But yeah, I'm not impressed by Sony whatsoever. And, you know, it might be that time to get rid of it. But what I replace it with is going to be most important. We're not going to go over new stocks in this video that I may be trying to replace it with because I haven't actually done research on that. Right now, I'm just evaluating my portfolio for what I'll get rid of. And everything looks to be doing 13%, 11% or more in gains year over year. NOBL, 10%. Apple 29% for the year. Not bad at all. Not bad at all. And so I'll just go over the stocks in my portfolio for everybody, make it short and sweet for you. As a present for staying this long, you'll now get to hear all 28 shares in my portfolio and what I've made on them just for the year, not all time. So from August 2023 to August 2024, we have Meta, and I'm just going to say the percentage, up 74.33%. SPY, up 26.55%. VOO, up 25.84%. Tesla, down 8.72%. Apple, up 29.14%. Goldman Sachs, up 60.58%. McDonald's, up $201.14. I should have bought a lot more McDonald's. I'm loving it. I am loving it. I am not expecting. I'm going to have to look at what went on with McDonald's this year that they're up so much. You know what? I'm going to have to do that. But I'm going to finish this out for you guys before we do that. We're going to do that last. So VTI, that's another Vanguard ETF, up $137.08. Costco, all right, this one is blowing me away. Up 762%, 762.85%. Costco, all right. NOBL, up 10.92%. Walmart, up 33.86%. Microsoft, up 25.89%. VYM, up 18.63%. DJD, up 19.43%. And again, this is just for the year. ADM, although they're down all time for me, for the year, they are up 227.81%. So can you imagine if they didn't go up 200+% this year, where they would be at in my portfolio? It's insane right now. All right, O shares. I love O shares. They were down for a long time, and now they're back up, baby. They're up 11.20%. I knew I should have held on, and I'm glad I did. O Shares is a single-family real estate firm, and obviously with high interest rates that can affect the profitability of the company. They pay a dividend every single month, not every quarter. So I absolutely love that. And I'm glad to see them rebounding and getting back into the growth column within my portfolio. They used to be 5% of my portfolio, and they might just have to get that increase now that I'm about to kick out Sony at the very least. Because if I can get them back to 5% right before interest rates cut, it makes perfect sense that we're going to make a lot more money. So you see, this is how I kind of think, guys and gals. So continue to watch and see. Now we got Blackstone. Obviously, you've heard a lot about them. And, you know, when you hear a lot about a company, it's time to make some money with them. And so I'm up 35.15% with Blackstone. NSA, it's a storage company. Obviously, when we're going through depressions, recessions, things like that, you want a place to store your belongings. And I am up 43.32% on that. VIG is another Vanguard ETF, up 19.45%. Procter & Gamble, also known as ticker symbol PG, up 13.56%. JPM, which is JP Morgan and Chase. Now, I also have a 401k with them because I used to work for them, but they're still 2% of my portfolio, and they are up 42.92% in my individual portfolio. But I have a lot of Chase stock in my 401k, so they're way more than 2% of my portfolio. And that's why I told you I'm just showing you one of my portfolios for all those people out there saying, oh, you only got $50,000+ in this account, but you had a video about being a millionaire. Where's the millions? That's why I told you most people are rich from their houses and 401ks, not these individual accounts. But just so that you are aware, I just want you to understand I have a lot more Chase stock than what I'm projecting. So don't think just because you see 2% here that is all the faith that I have in the company, because that's not indicative of the company itself. I have a lot more faith in Chase, and that's why I put a lot of my 401k into Chase. Now, I'm sure Chase loves the sound of that because that's 65 years of my money being invested with them. Well, not 65 years, but at least 40 years of my money being invested with them. And so, you know, in the 401k realm, that's a really, really good investment for Chase to have that long-term money. Next is going to be PM, Philip Morris International, 36.88%. Coca-Cola is next at 21.46%. ADP, 14.50%. PepsiCo, 2.24%. Pepsi is only 2% of my portfolio. Really lagging. Even Coca-Cola is outpacing it by so much. I'm not a huge fan of what I'm seeing from Pepsi. I did want it to compete with Coca-Cola a little bit, but only a 2% gain. It might be time to cut my losses on them as well. Pepsi, I'm going to have to do more research on them. I'm going to put maybe time to cut loose. I'm not a big fan of Coca-Cola either, but with those percentages, I'll keep them around. 21.46% is pretty damn good. Only 2% of my portfolio, so I'm okay with that. Then lastly, we have Johnson & Johnson, because Sony, for the year to date, for whatever reason, is showing blank, so maybe it's a break even on that, on Sony for the year to date. And so Johnson & Johnson is last with down 5.65%. So with that being said, did I already put J&J on my list to look into? J&J, look into it. All right, I'm going to have to look into J&J. Johnson & Johnson, it's American-owned company. And we'll have to see what happened with Johnson & Johnson. So as I promised, the last thing we're going to do is look at McDonald's, their stock, see why it's gone up so much. So first, I'm clicking on Yahoo Finance, going to McDonald's second quarter 2024. It misses expectations. This just came in. 1 minute read on Monday, August 12th. Revenue was $6.49 billion flat on Q2 of 2023. Net income was $2.2 billion down 13% from Q2 of 2023. Profit margin 31% down from 36% in Q2 of 2023. And then EPS US dollars 2.81 down from 3.17 in Q2 of 2023. So revenue was down across the board, missing expectations. But I won't lie, McDonald's kind of warned us that they weren't going to meet expectations. They started talking about adding value meals back to, McDonald's again. $5 biggie bags, things like that to entice people to come in, maybe even spend more money and not just be expensive like going to a restaurant. If you're going to spend $20, $30 on McDonald's, when we start spending $30 on McDonald's, then yes, it's time to just go to an establishment, sit down and get a nice meal. Because at that point, I can spend $30 at an Applebee's. I can spend $30 at a more upscale place like a Chipotle and get something to eat with a nice drink and beverage, with a nice drink and snack. So, when you start to get into that space where fast food is becoming dine-in food, oh yeah, I mean, the only thing you don't do is ask for a tip at this point, and you see, we expect more. The food is cheap as it is, right? It's cheap food. It's not super high quality, so we're not understanding where this increase is coming from. We understand that people are expecting higher wages and they're looking for so much more from their companies, which are supposed to be entry-level jobs for children to start working. But at the end of the day, whoever works, they live, they have to do what they got to do. And they're going to continue to be entitled and expect more. And so McDonald's has to make up for that any way they can. But at some point, McDonald's has to say, this is an entry-level job, and we cannot simply pay everyone $20 plus an hour. So with that being said, I'm actually shocked that McDonald's didn't go down with revenues going down, even though they warned of revenues being worse than expected. But because it's doing so good, because it's up $200 plus, I know McDonald's is going to be the brand that stands the test of time. Almost like I thought Sony would be, but also on the music side for Sony, they're not doing too hot. They're just allowing their artists to just kind of float out there, and they're not really putting time into music development. And I haven't heard anything about the PlayStation. They're very secretive about that as well. And so we really don't ever really know what Sony is doing and getting into. So I'm going to do a lot more research on Sony, and then I'll do a follow-up video to see if we actually stick with them. But honestly, I am so tired of companies that are not transparent. And I think that might be one of the reasons why people did not sell their McDonald's stock and why it's going on such a run is because McDonald's is more transparent. They are more open to speaking to the everyday consumer, to the buyers, to the people who are buying their stock and portfolio and saying, hey, we missed earnings, but this is what we're going to do next. This is how we're going to pivot. This is how we're going to change. And they let everyone know, hey, this is what we're going to do to be successful moving forward. And it's working. All right, it's working. They're getting that bag. I'm getting that bag. I'm happy. So if you like this video, make sure you leave a like, comment, and subscribe to the channel. If you want more stuff like this, if you want me to break down any particular stock that I just went over or stocks that I should be looking into, let me know in the comment section down below. I'll be happy to do that. And as always, I will see you on the next one. Peace.